Hey, everybody.
Hi.
Hey, hey, hey.
Morning.
All right, letting people in. Hey, Victoria.
Hi, Kirsten. Hi, Michael.
Awesome. I should
I'm
wait
gonna.
until Alfonso's here too, but awesome video the other day.
I know.
That was cool.
That was so fun.
It was so awesome.
Thank you. That was so much fun. I've had this in my head for a long time, but I never found the right house that I could have access to. So then when I saw that one in the MLS with Joel Nelson, I was like, let me see.
That was so
If
cool.
you guys do not follow Victoria Bruce on social, you need to. And you need to watch this video she and Alfonso posted yesterday because it was amazing.
So
Oh,
the backstory is, and
there's
please don't tell
Alfonso
my
right there.
husband.
Alfonso, we're
I know.
talking.
I was waiting. I wanted to wait for him, but I couldn't help
Yeah.
it.
All right, everybody. There he
There he
is.
is. There he is, the spy,
That's
the
right.
spy slash chef.
He's still
I
wearing the
thought
glove, it
the
looks like.
video was I thought the video was amazing. I was like, "Oh my gosh, I want to do
I
one."
want to get you in one for sure. Yeah, anybody who wants to do one. I mean, we got to like line up my
Yeah.
cameraman is my son, so it's like when I can grab him and then I mean, Alfonso knows like I literally go in and direct on the spot. And we had a couple props and the thing that you're all sworn to secrecy about is I dropped my husband's perfume bottle.
Oh no.
That was a prop that Alfonso used, broke it. It crashed all over the floor.
Oh,
It's a cement floor, thank
oh
God. I
no.
told Joel's people, but I did not tell my husband. And then Alfonso goes on and he finds that at the PG Mall, they're carrying it at Macy's. So like I literally run in
Buy it.
$175 later. This
Oh
was a
my.
costly shoot. Yeah. And then replaced it before my husband knew.
That's
So,
amazing.
but yeah, Stephanie,
Taking
think
that
of
secret
what
to
we're
the
going to do
grave.
together.
That's the
I
tricky thing with
surely
doing food.
will do.
The tricky thing with doing food
Michael,
videos like that is a big demand.
Cameras on, please. As you're filing in, please turn on cameras. Those of us who teach classes so appreciate it whenever there's cameras on because it's just when you're talking to just little squares that have somebody's name, it's not the same. Right, Mike?
I agree. There's some
We love,
pictures,
we
those
need some
help, but they don't do
smiling
that.
faces. So cameras on, please, if you're able to. All
Give
right,
me 2 minutes and I'll have my camera on. I'm
awesome.
getting dressed. Okay.
Okay, so we're going to get started. People will probably still file in as it gets started. Should you have to leave at any point, I am recording, which will be uploaded, so you will be able to watch this later, or just if you need to reference it later. So those of you who don't know Mike Jenkins yet, I've worked with Mike for a while now. I don't even remember how long I've worked with Mike. We've done a bunch of transactions together, and he's awesome. I love working with Mike. He's with Main Street Home Loans, and he's sharing today the FHLB grant. I've personally used FHLB with clients, and not only is it a terrific grant for you to use with your clients, it is terrific for you to use this for lead generation. Like, this is how you're going to get buyers or people at least interested in talking to you just by you being able to talk about FHLB. Even if they end up not being able to qualify for it, it's a terrific tool. Um, so, with that said, take it away, Mike.
Thanks everybody for joining today, and sorry for the ones that can't and are going to be joining in later on. Hopefully we'll be able to check out the video here. We're going to go over FHLB. As Kirsten mentioned, this is an awesome program. And every single one of you, if you don't at least do one of the deals, because the funds do go kind of quickly, you should at least be able to bring in some potential leads here. People
Yeah.
want free money, especially these days. Like, inflation, home prices, just battling this and that. And so when the government's giving out some free money between not just some money, between 15 and 20,000 bucks, huge chunk of change. A lot of people qualify. We're going to kind of go over some of those today to kind of give you a little take. It's not your job to go out there and know the specifics enough to know whether they qualify or not. Your job is to understand the program enough to be able to go out there and market it, have those conversations, create the rapport, then send them over. I'll be able to kind of determine if they can. Hopefully they can. And if they do, amazing. If they don't, we'll find something else that'll be a good fit for them. The program overall is pretty straightforward. There's not a whole lot to it. It's mainly based upon income, and the income does get a little tricky. So I'll kind of go over some tidbits of that just to kind of give you a little bit of a glimpse into it. But the benefits are huge, so we're going to go over those. I'm going to try and kind of go over a couple of bits and pieces and then take some questions, couple of bits and pieces, take some questions. So if anybody has them, just hold until we do a little break and we'll try and get them all. I put my contact information, my email, and my phone in the chat. So if anybody has any specific scenarios, want to kind of dive into it more, I've also been offering up kind of opportunities to take 15 or 20 minutes to do little Zoom calls to be able to chat with people if they want to dive a little bit more into it. Again, we should be able to cover most of it today. I'm more than happy to chat. Okay. So let's share and go over what we are looking at here. So, oops.
Recording in progress.
All right. As mentioned, FHLB, it's between $15,000 and $20,000. So it's either going to be one of these three increments here. Okay. FHLB, if anybody is curious, it's the Federal Home Loan Bank. You may see a city tied to it. For us, it's the Federal Home Loan Bank of Atlanta, just because that's the hub from Maryland down to Florida. Okay, there's a couple of different sections throughout the U.S. covering all 50 states. Notes that it's very specific for location, and there aren't any lenders that I know of that have access to multiple states because it's through local banks. And so we have access to do this in Maryland. I know Pennsylvania does it. I'm fairly positive that Delaware, Pennsylvania, Virginia, DC, everybody should have it because it is a federal grant program. I can only assist here in Maryland. So just so you guys are aware of that. Pretty simple. It is for does not need to be for first-time home buyers. Okay. But it does need to be for a primary residence. So we can't use it on second homes, can't use it on investment properties, primary residences only. As mentioned, in the state of Maryland, they don't really care about what type of property. So it can be for single families, townhouses, and condos, even multifamily. And it can be used on pretty much any loan type as well. Okay, different programs. Not limited to conventional or FHA. You can do USDA. You can do VA. It gets a little trickier. You can sometimes do it with.
The inspector tells you there's more.
Yep. There's sometimes you can use them with non-QM mortgages, but it gets a little tricky within there. So that's something that we'll kind of work with on a case-by-case basis. It's a huge chunk of money, but they do require that the buyer puts forth at least $1,000 of their own money. So it's called the minimum borrower investment. Some programs have them, some don't. But this one means you need to just put up $1,000 of your own money. So the $20,000, some of the lower price points, that's going to cover most of the down payment and most of the closing costs. So just note there that the buyers, even though they could technically get a bunch of seller contributions, that's pretty much the minimum that they're going to need there. There is a counseling required, but the counseling is not until they're approved for the grant. So it's pretty much going to be one of the very last things that they're going to do prior to wiring their funds to the title company and settling. There's nothing that the clients need to do prior to getting under contract on a home. They don't have to take any education. They don't need to do anything. They just need to be pre-approved to make sure that they meet the requirements for the loan program they're trying to qualify for and the eligibility for the program itself. So I'll take a quick break here, see if you guys have any questions, and then I'm going to go into kind of the specifics of each of these buckets. So does anybody have any questions on kind of some of the qualifications or anything in regards to the program? Again, the federal program. All good?
This
All right.
isn't limited to like first-time buyers, you said, if I remember.
New. So that's what I'm
I
going to go
thought
over
you
next.
said
So
that. I didn't quite, I was writing something.
no worries. So that's actually a big thing here. So
Sorry,
in
Mike,
full,
can I ask a quick question?
sure.
I know up to 15,000 is first time or non-first time, 17 is first time. The community partners are also first and non-first?
Yep. So
Okay.
that's what I'll dive into now here. So there's going to be three different buckets here. This one is the Workforce Plus. This one is known as the AHP, and this one is known as the Community Partners. Okay. In order to qualify for these, they're looking pretty much solely at income, and it is going to be household income. Let me see if and this is something I had sent out to a lot of you when we met, or I sent out an email about it. I can gladly send this over to everybody as well. It is labeled 2025 income limits just because they don't typically update the income limits until the beginning of the fiscal year, which is usually July. So even though it says 2025, they're still working off these income limits. Okay. Household. So household income. So if you have a household of 2 adults, 3 kids, you're going to be a 5-person household. Okay. The household limits are increasing each person in the household and are going to be different for each county. Okay. And I know a lot of you are working through a couple of different counties. We have a lot of agents that are going to be focusing more on the Baltimore County, Baltimore City, maybe Howard and Hartford. A lot of you guys are going to be doing PG, Montgomery, maybe even as far as like Frederick. But it is anywhere in Maryland. So you're going to see all of the counties here. Okay. Again, DC is not on here just because we don't have access to DC. If you do have clients in DC that want to qualify for this one, you just have to find somebody that does do it down in DC. So you have to reach out to a DC located bank. Okay. The income gets very specific here in a lot of scenarios. So this is why I kind of recommend if you have a potential client that is you think might meet the mold here, have them reach out so we can go over it. So if it's one person and they're very straightforward, let's say they're looking in Baltimore County and they're $70,000 salary. Okay. No commission, no bonus, no second jobs. We need to account for any and all income. We have to get tax returns, W-2s, pay stubs, bank statements. And so note if we see that on the bank statements, they're getting recurring income for babysitting or some sort of side hustle that they don't technically have a business for, sometimes they can account for this in here. Okay. So that's something that we want to be very specific about because some people don't think that they're not claiming it, so it shouldn't be counted as income. But when the program goes through, because it's a federal program, they're going to underwrite these loans. They're looking at the bank statements. They're going to see recurring deposits. They may require we account for that as income. Okay. But their $70,000 salary, 1-person household, they're going to qualify, no additional income, qualify all day long. Now they're going to annualize the income. This is, again, something that you don't need to get super familiar with, but I thought I had a little chart up here. Let's see if I can had a little calculation up here. I was just going to share with you that we use on our end. But so with the annualizing, a big thing that we see, especially this time of year, is people that might have gotten paid some additional income from 2025 that gets paid out in January of 2026. Okay. Or you may have a buyer that's they're seasonal and they're doing a little bit more work in the beginning of the year. Luckily, we're not at the holidays because at the holidays, people are working the retail business are working a lot at the end of the year. But if you have somebody that's working a bunch at the beginning of the year and maybe they don't work as much throughout the rest of the year, if they're making twice as much in January and February as they do some of the other months, even though their overall income would technically be under this income limit. They're going to annualize. So if they're making $10,000 in January and $10,000 in February, it's going to look like, and the way the program is going to calculate is they're going to make $120,000 a year, even though at the end of the year they might only be making 70. So the thing that stinks is that some people that should qualify for the grant don't qualify. Okay. So that's what I'm here to kind of help out with the determining. You guys don't need to specialize in that. That's what I'm here for. Okay. There are some potential ways around this here. And so one of the big ones is you see a couple that's looking to purchase a home, and maybe they're not married. And maybe with both of them on there, they're making too much money to qualify for the grant, but maybe they're able to qualify and just do it in one of their names. Okay. They qualify for the loan, just one of the names. They qualify for the grant, one of the names. What we can do is still have the discussion about potentially moving forward with the purchase and doing it in just one of their names. Okay. Big chunk of money. Most people in the beginning say, hey, we want to buy together. Then they find out they get $20,000 in free money. Their moods change. And you can always add somebody to title down the line. So if they do end up getting married or just deciding a couple of months down the line, you can still add them onto the title so they still have equal ownership. Okay. If they're a married household, can't really get away with that one just because we're going to have to provide the tax returns. If it shows on the tax returns that they are married, then we're going to have to dive deeper into it. We're going to have to show that, hey, there are multiple people living in the household. So I'm not saying necessarily hide people that are living in the house, but there are ways that we can kind of work around this. Okay. The income limits here. So you can see this is for the AHP and the community partners. Okay, that is the 17.5 grand and the 20 grand, AHP and the community partners. They are for under 80% area median income. So these are the 80% income limits for each of those counties. Pretty much they have to make under this. If they make under it, they're going to qualify for this. If they're over this 80%, which kind of tends to be a little bit more the general public, there is another option, and that is this Workforce Plus. This is much higher income limits, and this is from 80% to 120%. Okay. So your income is either going to fall in one of three brackets, either going to fall in this one, or they're going to be over. If they're over, they're not going to qualify for any of these. So if you have somebody making well over these limits and you're in your conversation, no necessarily need to kind of entice them with this one if you know darn well that they're not going to qualify. But again, this can reach a lot more of the general public, especially when you get down to some of these counties outside of DC, Montgomery and PG County, up to 137 for a one-person household. You have a family of 5, you're looking at 212,000. That's a good chunk. All right. So again, mainly based upon income. So this stuff here is very important with those because again, the way we have certain ways we have to calculate their income, and they're either going to meet those requirements or they're not. Very rarely does the program allow for any exceptions. They're doing these loans for the entire country, or I should say for like Atlanta, they're covering probably about 7 to 8 states within there. So there's a lot of money, a lot of applications. They basically say, hey, we don't have time to go through and nitpick this sort of stuff. We're setting the guidelines. You meet the requirements or you don't. Okay. Any questions on the income side of things here? And this is something where I encourage people to reach out because again, if it's probably going to be a little more specific scenario.
Hey, Mike, I have a question.
Sure.
For the workforce, plus, do they have to have a certain occupation for that one?
No. So for the AHP and for the workforce, it is simply based upon income. So it doesn't matter what line of work. You can be self-employed, you can be W-2'd, 1099. Doesn't really matter what the income is here. It's just you need to meet these income requirements. For the community partners, that does play into the regards to the employment type, and I'll go over that in a second.
Okay. All right. Thank you.
You're welcome. I think we had another question in there. Was it Joe?
Yes. Hey, Mike. So if it's a married couple but filing single and they are but then, but the one person is a community partner, like she's a teacher, but the husband is not, and they are slightly above the ranges. Can they still qualify for this?
Not if they're simply filing jointly, because a lot of people will do that for other reasons, but they're still married. They're still likely living together. Now, there are some circumstances, again, where they sometimes will allow for exceptions. Very rarely do they. But let's say we have a married couple that filed jointly in 2024. Okay. And that was the last tax return. They haven't filed 2025 yet. But they either got divorced or are separated. Okay. So maybe in 2025, when they go ahead and file at that point, they're going to be filing separately. If we can provide enough documentation, separation agreement, change of address, very, very detailed supporting documentation, we have been able to get it set up so somebody could qualify because there's a good reason behind this. So the couple might be no longer staying married, not divorced at the moment. And so one individual might be staying in the current place they're living in. The other one might be moving out. And if the one that moving out trying to purchase a home, maybe they're looking for a good school district for the kids. They just want some extra money here. And if we can establish that they qualify and that they're married, but going to be buying this house on their own, that is an exception we have been successful with, luckily.
Okay. Got
Okay.
it. Thank you.
You're welcome. But yeah, just filing separately doesn't quite fit the bill
Okay.
there. So again, with those, the 15 and the 17 and a half
There's
grand,
a
you're
couple
gonna
more-
eat
Hey,
one or the other.
Mike, there's a couple more questions. Jeanette and
Go for it.
Natalia. Yeah.
Awesome.
Yep.
Fire them off.
I have a question about the unmarried couple. If one works and one does not work, can they still file jointly?
So does one of them not work at all?
No, she's a stay-at-home mom.
Okay. So in that scenario, there is something known when this is actually good to kind of go over. When they are applying for the grants, which they don't apply for the grant until they're under contract on a property and we have the loan conditionally approved. Okay. The buyers are required to fill out what's known as the intake form, the FHLB intake form. So on there, they're filling out who's going to be living in the household and any potential income. Okay. Now we have to pair that intake form with the documentation. And so the documentation is going to be the tax returns, the W-2s, pay stubs, any income documentation. If there is an individual that living in the property that doesn't work, and we only need to account potential income for anybody over 18. Okay. So if you have a 16-year-old or any kids there that don't work, we don't have to worry about it. You have an 18-year-old that doesn't work, or in this scenario, you have a spouse that doesn't work. They don't have any income. So what they're going to complete is what's just known as a no income letter. So stating, yes, they're going to be living in the house, but they don't receive any income. And that scenario, that's actually helpful. Okay. Because in that scenario, they are going to have a higher household size and no additional income. So if the one individual's, let's say the one individual in the couple is working and they make $75,000 a year and they're looking to purchase in Baltimore County, they're not going to qualify for the program, but they're married. The other person is living with them. The income limit is now 83. So that's actually helpful. And so that's good to know whether you have kids or in a scenario, you may have an adult parent moving in. So we're seeing a lot of that these days. People are having to move into new houses because they need more space to allow a family member to move in as opposed to going into assisted living. So now you have a person in the household. We do need to account for their income. They may not work. They may be receiving Social Security, pension. If they do have any income, we need to account for it. But usually if it's going to be Social Security or a pension, it's not what they were making when they were working. So it's going to be significantly less. And that's something that could potentially help out. So good question there. And then who else do we have? Somebody else had one?
Yes, I have a question, Michael. Are there any immigration requirements? Do they have
No,
to be a citizen, green card holder, illegals?
not for the program,
Mhm.
but yes, for the potential loan type. Okay.
Mhm.
So that just goes into qualifying for the loan in general. So if you're a permanent resident alien, you have a green card, you're going to qualify for FHA. You're conventional. If you're a non-permanent resident alien, you're going to be restricted to a conventional loan. You can't go with any of the government loans, which would be VA, USDA, or FHA. So no requirements for the program, yes requirements for the loan type.
All right. Okay. Thank you.
You're welcome.
And Victoria.
Hi, Mike. So my question is, if we are writing a contract and our client is hoping they get this money, since we have to be under contract to then get the money, is there something we write into the contract saying like, and if we don't get this? Okay.
Absolutely. I
Yes.
highly recommend that. So
Yeah.
just make that a contingency that the contract and the sale of the purchase of the home is contingent upon the FHLB because again, the program has a limited amount of funds. So that's kind of the everybody says like, what's the catch? There's no catch. If they qualify, they can get the money. But note that the funds are limited. So there's basically going to be two pots. There is a national pot where they put in tens of millions of dollars. And then when that's used up by all the different banks throughout the US, the program closes. Each subsidiary bank has a second, like their own kind of set of funds available. And if that one runs out, then the program closes. So that's good to know here as well, because we here at Main Street Home Loans, we're a little greedy and we are the only ones that have access to that. We're not sharing with any other lenders. Okay. So what we have available, I know down to the penny how much we have available. Now, if the big pot runs out and we still have money left, it's gone. Because again, it's all based upon which runs out first, the big pot or our pot. But
Can I just interrupt you for a second?
Sure.
Sorry. At what point in the year does it normally run out in your experience?
That's tricky. So last year we had the same amount of funds and we went until about June. Then the federal government ended up putting a little extra money in there. So we ended up getting it for about 3 extra weeks after that. Okay. So I think it was like beginning of June and then ended up kind of going through June. Okay. I personally don't know if I expect it to be around as long this year because we are looking at a totally different market. Last year, this time of year was very competitive pretty much across the board. And with this program, note, even though it's amazing for the buyers, it does take longer to process. So sometimes you need to negotiate to kind of work that in on your offer. And so if it was a multiple offer situation, it is a little bit trickier to get your offer accepted with the longer closing time. All right. Right now, I'm recommending 45-day closings for these. Later on, as the program gets busier, it could be 50, could be a little bit more because a lot of this, after it's conditionally approved and we go ahead and submit it to the program, they do their thing. And if they're backlogged, like I think last year we were up to 21 days or 22 days at one point for their turn times. So we said to submit it and then we had to wait 22 days before they reviewed it and either approved it or came back with any conditions. And if they come back with any conditions, which we don't see too many conditions, luckily on our end, knock on wood, because we do so many of these and we know exactly what they look at and exactly what they need. But if they happen to come back with anything, you basically go back in line. So it's not always fun for anybody, but it is amazing for the buyers. Okay. And so with those turn times in there, like now we're seeing seller contributions, we're seeing price drops. So we're seeing a better market for buyers and the agents, the listing agents and sellers are a lot more willing to entertain and accept these offers because they might not be entertaining any other potential offers. So with the more people getting under my suspicion here, it hasn't even opened up until it doesn't open up until Monday. My suspicion is we're going to see a little influx up front and the funds are going to go a little bit quicker. So I'm going to take a guess and say we're going to see it through May, but that's not guaranteed. And I will keep you guys posted if we're working with any clients, because if we have people out there actively looking, and we see the funds start to get low, I'm going to let you know so we can say, hey, they're getting dangerously low. Either go find something soon or be prepared. We'll have a backup plan for them, hopefully. So, cool. What else we got? So I don't want to take up too much time because I know we only got the half an hour. If we go over a little bit, and everybody's got my information, so if they want to reach out, they can.
I have a follow-up.
Sure.
What about if they have a big chunk of money in the bank?
So if they have a big chunk of money, if it's less than 20% of the down payment, totally fine. If they have more than 20% to put down, then we need to do an asset test and account for interest income on those funds. So that can be extra income that they're not technically receiving, but they have calculations that we have to do to count that extra income. If they have $500,000 in the bank, we might have to couple $100,000 in income based upon the interest there. So that's something that we would
But they
go
could
over with them.
qualify even though if they have $500,000 in the bank?
Yeah, technically.
Wow.
And so for like elderly folks, let's say they're on fixed income here, they don't have a lot of liquid assets, and so they want to pull from their retirement account, so they're receiving Social Security, they want to buy a new place, we can still help them because it's just based upon income. Okay. So yeah, totally possible. I mean, we've helped lots and lots of different walks of life here and lots of different situations.
I have a follow-up question on what Victoria said. If you have a lot of money in your account, some people consider that for their retirement. Does that have to be in a special account to consider it a retirement?
No, I mean, so we still need to account if they have assets because we have to get all of their bank statements. So we have to get retirement accounts, investment accounts, checkings and savings accounts. We do need to do a deep dive here because, again, the federal government says we're about to give you a big chunk of money. We're just trying to give this to people that we see as being in need. And I do think that's kind of interesting that they do, or surprising that they are going to allow people to still get this money if they have the money. But another big thing here is you don't need to be a first-time home buyer. Okay. And we've helped people last year that currently own homes purchase a new home. Now, there's reasons that sometimes people might be able to use this money because maybe they don't have a ton of equity. Maybe they've had a couple new additions in the house they've outgrown. So they kind of consider they need this money to help them buy a new house. But in the end, like most other down payment assistance options are not, actually, there's not really any out there except for Maryland Mortgage Program, certain scenarios that allow you to own a home and still qualify for any down payment assistance.
Okay. And what you have on the screen now, is that accessible as a flyer if we wanted to?
We'll have new ones coming out on Monday when the program actually opens. They don't want us to advertise this. And also note, we're going to have a social media specific one. So I'm glad you brought that up, Jeanette. We're going to have a social media specific one. So unfortunately, it can't be branded, but it will be allow you guys to kind of post it out there to kind of grab that attention. My suggestion is talk to people. Open houses, phone calls, reaching out to your sphere. When you bring up this potential huge chunk of money, people get interested. And then you can take that opportunity to fill them more. When you put this on there, some people will just kind of find a reason why they may or may not qualify, or you want them to reach out and kind of chat with you more about it. So we'll definitely give you guys some of those when those come out. You just got to reach out to me. I would say, give me Tuesday or Wednesday, or send me an email Monday and I'll just send it.
If you want to send me something, I can distribute it to everybody.
There we go. That's perfect.
Let's do that. That's much easier.
I love it.
Yeah. Joe has a question.
Awesome.
So if we're hosting open houses this weekend, can we use this flyer just as a conversation starter and let them know that there's more information coming out?
And I have them working on yours. We got a big influx of people requesting them. So I sent yours over when you sent it over on Wednesday. So hopefully we can get it for you. Are you doing one this weekend?
Yes.
Cool.
Yeah.
Let me see if I can try and speed that up to try and get that over for you.
Awesome.
I know a couple of you had requested them, which they're being worked on. So if you haven't, we can work on it.
Thank you.
So kind of get back to the program here again, because I can do side questions at any time. Big thing here is with the AHP, the 17.5, you need to be a first-time home buyer, which just means that you have not had your name on any real estate within the last 3 years. Okay, so you can have previously owned, you're not a first-time home buyer in like the state of Maryland any longer, but you can still be on the federal level. Okay, for the Workforce Plus And for the community partners, you do not need to be a first-time home buyer. Okay, that is huge. And somebody had this question earlier, so I want to make sure I go back to this in regards to the employment. If you're under 80% area median income, you're guaranteed at least to qualify for that 17.5. If you are an educator, law enforcement, firefighter, first responder, healthcare workers, veterans, you can qualify for the additional $2,500. Okay. Again, all based upon income. Now, if you're one of these, but you're over 80%, then you're just going to be unfortunately downgraded to $15,000, which is still freaking stellar. Because you're over that income limit. So you're still in a great situation there. You're just not getting the 20, even though you're a veteran, you're getting the 15 because it's based upon income.
I have a question.
Sure.
Okay, so for the workforce housing plus, is there a timeline that it's forgivable? Because I don't see that on
I was
that
going to let you
particular
do
one.
that. And I was like, let me come back to this one. This
Okay.
one is a true grant forgiven day one. So as soon as you sign those papers, it's forgiven. These two are in the form of a 5-year forgivable grant. So what they do is they're going to forgive this grant at a rate of 20% a year. Okay. Now you can still refinance within those 5 years. Totally fine. It's only if you sell. If you sell within the first 5 years, you need to repay that money. Okay. Not the full amount, just whatever hasn't been forgiven. And the way I look at it, pretty much any way you slice it, even if you're in there for like 2 years, 3 years, it's still a great option. Let's say you got the $20,000. You were in there for 3 years. You got $12,000 in free money. And yes, you had to pay back $8,000, but that most likely going to come out of the equity in your house, meaning you don't have to really come out of with any extra out of your pocket, unless your house is underwater or something like that, which hopefully it doesn't happen.
Monique, I think Monique had a question. Monique, you want to come off of mute and ask your question?
Is this something that they can qualify for during their pre-approval?
Yes, absolutely. So that's what we're going to do is we're going to go over your job is go out there, market this program, find buyers, do what you're already doing, get people in the door. And then when we go through the pre-approval, we're going to be looking at all sorts of different programs and products with them. This time of year when this is available, this is kind of going to be our front runner, our priority, because we want to see if people can get these funds while these funds are available. So absolutely going to figure that out.
And how long do they have to use it?
Until the funds run out. So again, they can't do anything ahead
So if they
of time.
qualify for it, say they qualify for the 15, but they don't buy right away, it's theirs only until it technically runs out, but they qualified.
So you can qualify, meaning you meet all the requirements, but you can't apply until you are under contract and conditionally approved. So what we're going to do with the clients, I recommend you talk to them, find out what they're looking for, a little bit about their situation, say, hey, think you might qualify for this grant. Why don't we go talk to the expert, connect them with me. I'll go over. If they qualify for the program and the loan, and we say everything's good here, like, let's try and get you this money. The next step is to get them under contract. And hopefully, they say as quick as possible, but quickly enough where we can get them under contract while there's enough funds left. Because if they get under contract and the funds run out a couple of days later, and we weren't able to conditionally approve them in time and get them submitted to the grant to have that underwritten by them and approved, then they're not going to get those funds. So that's why, again, I'm going to kind of, if you have a client that's pre-approved and out there looking, we're going to stay in communication so I can let them and let you know that the funds are running low. So if they are running low, we say, hey, like, go get under our contract now because you're not guaranteed these. Now, if they are, let's say that there's a little bit of money left, but we're still going to shoot our shot there, we're going to make sure we have a backup plan. And if we don't have a backup plan because they don't qualify for anything else, let's say it's the Workforce Plus and there's nothing else out there for them because this is very specific. That's why you're going to have that FHLB contingency in the contract. So if the funds run out and your client doesn't get these, that they're not going to be held liable to still move forward the purchase because you had that worked in as a contingency. But we're going to do everything in our control to try and prevent any of those issues like down the line, because we do monitor how much money's in there. So again, that's one of the huge benefits of us not sharing the money, because I can talk with the other LOs in our company to see who's submitting it when, and we keep track because we're all on the same team. So we're not competing against those funds against anybody else in our company, or more so in other companies. So some of the subsidiary banks will have like 5 different lenders that they're working with. So you don't know if you go submit one and one day there's $2 million left and you think it's fine, but the day before you, a bunch of people submitted, and then all of a sudden you're under contract and the funds are gone, then you're SOL. So that's big.
Victoria had a question.
Sure.
Okay. Just 2 quick things. People talk about, I've heard lenders talk about layering these things. If you get this, can you get like that PG County 50,000? Is there other Maryland stuff that you could get different grants?
Yes, but it's going to be situational, because this program doesn't have too many specifics in regards to what can be paired with, but either the other programs might, or more specifically, the loan type might. Okay. So when you're adding these additional funds on here, and like not so much for like the Workforce Plus, because that's a true grant. So it's just basically like we're just counting it as they have $15,000 in extra cash in their bank account. These two, since they're forgiven over the 5 years, it's known as a subordinate financing or a second lien. So if you have another grant that you're trying to pair with it, most of the time we need to make sure that that grant is okay with being in the third lien position. Okay, so your first lien would be your main mortgage, the bulk of it. The second lien would be this lien here, because again, it's not forgiven right away. And the third lien would have to be whatever you're trying to pair it with. And so those other grant programs, some of them might say, hey, we don't want to be in the third lien position. So if let's say your buyer gets in, they've stacked a couple loans. If they default, they lose their job right away and they default on their mortgage and they foreclose, the first lien that's getting paid off is going to be the first lien, which is the bulk of the loan, okay, that they're getting through basically the government. The second lien that to be paid off is going to be whatever's in the second lien position, which is going to be this grant. If there's a third lien, they're the last person to get paid. So if there's not enough equity in the house, then that third lien isn't going to be paid in full. So it's a lot riskier to those banks or subsidiaries that are offering up those additional liens. So they need to allow for these stacked grants, or because sometimes they're also in the form of loans. So PG County, that's in the form of a loan. It's a forgivable loan, but again, we need to make sure that goes on top. And then on top of that, some programs will have what's known as a total loan to value max. Okay. So meaning you can't go over a certain point over like 100%. So you can't basically get more money than the house is worth. All right. Sometimes they'll let you go over, but they're going to have a cap on how much you can go over. Okay. So for like one of the big, most popular conventional loans is Home Ready and Home Possible, that a lot of people that'll qualify for a conventional loan would qualify for that, because let's say they're under 80% AMI, that is 105% total loan to value. So if you're buying a $150,000 house and using 20,000, that's probably going to put you at that 105 to begin with. So you can't stack anything on top of it, because the first lane says, no, you can't do anything more than 105. Does that make sense? It gets a little in depth there. So to answer your question, yes, there is
If
potential.
I shake my head, I got a little lost, not gonna lie.
It's all right, because that's where it gets very specific here, and it really depends on what type of program they're going with. So to answer your question, there is potential to stack, but not everything in every scenario.
Okay.
And really, I think in the end, what you're doing, like, you're connecting with Mike to figure it out, not you figuring it out. Do you know what I mean? Like, it's more like, I don't know, let's ask Mike, and find out, because he's going to have to look. We're not going to be able to answer the question.
I probably got a little more technical than I needed to there, but
I had one
shows
other
you how in depth
question.
this sort of stuff can get.
I'm scheduling. Oh, sorry. Go ahead.
Oh, let me just, this is real quick. If you are recently divorced You owned a house with your ex. Are you a first-time home buyer?
If it's within the last 3 years, no, you're not a first-time home
You're
buyer.
not.
No.
Okay.
So again, if they qualify for one of these, it doesn't matter. If it's this one, they would have to wait until it's been 3 years. After 3 years, it sets on the federal level.
Okay.
Joe, did you have a question?
No. It was a very lighthearted comment, so I
Oh,
can
okay.
say that for the end.
So I think I kind of covered pretty much everything in regards to the program here. It's pretty much here just with the specifics of income. And there are some different scenarios you might come across here. So run them by me. I'm happy to help out. But at this point, it's about getting out there, advertising this to your clients, talking about it as much as possible, letting them know. And without scaring them, let them know that there is a sense of urgency because the program opens up on the 23rd, which is Monday. And it's only around as long as funds are around. I can keep everybody posted if you're working. I'm not just going to go throw it out there to everybody all the time, but if we're working with a client, we have somebody pre-approved out there actively looking, then we're going to let you know where it is. So if we need to kind of speed up the process or if we're okay to still kind of look out there for the right property. And what was I wanted to kind of pair something with that, but that don't have to come back to me there. Nope, I forgot it there. So must not have been that important.
Mike, are you going to share this as a downloadable PDF for us?
Next week when the program comes out, I'll be able to send you guys one. Or if you want a specifically, and I think I
You know what,
sent you, right?
Mike, you sent it to me.
One.
And for everybody, the thing that Mike
Yes.
has on the screen now, Mike already sent it to me and I posted it into the coaching community. So you can see it right there. If you log into Go Collab, it's in there already.
Yeah, I saw that, but it wasn't downloadable. So I was just trying to figure out how to, so I can have something in hand. So,
Yeah.
but I could wait until it comes,
You know what?
until you
If
send
you
it, Mike.
just right click on it, Stephanie. When you have a graphic anywhere online, if you right click on it, you can download it.
I
Okay.
think I sent you. If I didn't, I'll resend it. But I thought I sent you the the co-branded flyer for yours. Did I not?
No, you just sent me this in the email, but I wasn't able to download it. It
Yeah.
wasn't
Okay.
Just
downloadable.
try the right clicking, Stephanie. I think it'll work for you. All right, Joe.
So you walked us through all the qualifying income, right? Now, as realtors, are we allowed to talk to them about, hey, if you're in this range, you need to be in this range to qualify for the loan? Or is that more like, this is the program, but for more information, talk to Mike?
So that's up to you. And I mean,
Can I just interrupt? You don't want to try to explain it, Joe. Don't do it because here's why. If you have a potential buyer client on the hook,
Uh-huh.
right? If we can get them to talk to Mike, they are more on the hook. Do you know what I mean? So
Yeah.
I would rather them go and talk to Mike, even if they aren't going to qualify, because then he's going to connect them with what help they might.
Okay.
So for you personally, no matter, that's the best way to
Just direct them to my, okay, got it.
exactly.
Awesome. Yeah.
plus, then you don't build them up thinking that they're going to get this money,
Yeah.
and they don't.
Yeah.
And then if you just kind of
Yes.
advertise it and I say, hey, I'll break the bad news to them, but I'll follow it up. Be like, oh, so I know we were looking at this one. You don't qualify for this one, but here's something else that is available to you. And try and present that as a good solid option there. Because again, we don't have any flexibility here because they're very strict on it. So I wouldn't recommend getting yourself in that position either.
Okay, got it. Okay, thank
And
you.
besides, we don't want to just tell them no and then they give up. You know what I mean? Like,
Yeah.
like, like find another way, you know?
Yeah. The less details we give out, the better. So yeah.
We gotta just get him to talk to Mike, and then we can take it from there, you know. I think Lisa has her hand raised.
I do. Mike, you said just at the beginning, but I didn't write it down. You said the FHLB, Federal Home Loan Bank.
Correct.
All right, I just want to be able to spell that
Yeah.
out if I need to. And
And then
how many years W-2s and or tax returns? Like y'all have a client that's interested in going that way, so I'm trying to help her get herself together before we talk again. How many years W-2s should I
2
be
years. So it's
suggesting? 2 years.
typically going to be 2 years tax returns, last 2 years W-2s, 2 most recent pay stubs, last 2 months of bank statements.
Got it.
So 2, 2, 2, and
All
2.
right. That's all I had. Federal Home Loan Bank.
And this might not come up, but I kind of like to throw this out there just in case it does and I miss out on it, or somebody acquires with you. When they're taking the home buyer counseling, which is like one of the last things prior to settlement, the names are very generic. So a lot of people get very concerned. They're like, this company's reaching out to me about taking an education course. And most of them, they know it's coming, but the name is just very generic. So if people like get concerned, I can't even remember what they are there because they're like so generic. But so if anybody reaches out and they're like, hey, just always tell them to double check with me there. But some people always get concerned because they're also going through the process. They've been through a lot. We might go over at the beginning and then 45 days later, they're taking that education. So it's pretty basic, just like that's why we call it the FHLB. The Federal Home Loan Bank is a mouthful. So.
All right.
Everybody
Thank
should be at
you.
least getting some leads off of this. Doesn't necessarily
Absolutely.
buyers, but should be getting
This
some
you
leads.
should get some leads from this. This is going to be exciting. So when Mike sends it to me, I will send it out to all of you who came to the session today. If anybody's watching the recording later, reach out to me if you need something from it. But I will post it to our core coaching community as well, just so we can really start getting the word out there. And the recording of this session will be on there and the community too. And thanks for coming, everybody. I'm going to put Mike's contact info in the chat again, just in case anybody joined later and wasn't able to grab it. I also put it in the coaching community so you can see it there.
Mike, are you on Instagram, on social media, so we can tag you on the post?
You can still tag me, yes. I'm just not very active on there, so I'd have to reach out to find a handle or what is a handle for Instagram, and I'm not sure for I guess just Facebook name. So hopefully you can find me just by searching me. It's usually me and the kids there, but yeah, I'd have to go do some digging to find out what the actual name is.
Okay.
It should be. I absolutely should be. I shouldn't say that. Pearson's, I'm sure out there.
We'll work on that.
Yeah.
Yeah.
Pearson's probably telling you guys
Some
to get
random
out there
Mike
and get yourself
Jenkins.
on.
Right.
There's only 4 of us here in the Baltimore area, so.
All right, everybody. Thanks for coming today. And thank you so
you.
much, Mike, for sharing with us.
Bye-bye.
Yeah, thanks, Emily.
Thank
Kirsten.
you.
Mike.
Everybody.
Thank you.
Bye,
Thanks, Mike.
everybody.
Bye.
Thank you. Bye.